This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, we'll be talking about the $1.2 billion capital raise announced by Air New Zealand. So if you're an existing shareholder in Air New Zealand, then you are entitled to buy an additional 2 new shares in Air New Zealand at a very discounted price. So in today's video, I'll be going over the deal structure, what this means for you as an existing shareholder in Air New Zealand, and what this means for you if you don't decide to partake in the capital raise. We'll be talking about that in today's video. As well as that, we'll be talking about the valuation of the business as well, and how it stacks up at the current valuation today. So if you enjoyed today's video, be sure to hit like and subscribe. As always, none of this is financial advice. I'm not recommending you to buy, hold, or sell Air New Zealand. However, I'm here to give you more insight and information on what this means for you as an existing shareholder, because I know a lot of retail investors don't really get the gist of what a rights issue actually is. So I'll be explaining this today in very simple terms. If you do decide to partake in the raise or not, it doesn't really affect me, but hopefully this video will help you out. And if you do find this video helpful, be sure to share it with someone who you think will benefit from this information. Before we begin, I do want to shout out Sharesight. Sharesight is a platform that I personally use to help me file my taxes during tax time. As you know, we've passed 31st March now, so it's time to file taxes again. And if you have over 50,000 invested into overseas stocks, then you have to calculate what is called a foreign investment fund tax, or a FIF tax. And for me personally, that's what I have to do. Calculating it manually will be very tiresome and time consuming, but with Sharesight, it will automatically help me calculate that. So when come tax time, all I need to do is click a single button and it'll spit out a number for me to file my taxes. So if that is something you're interested in, be sure to check out the link down below. You get 4 months for free when you sign up with an annual plan. As well as that, I have a link to a video over here which should give you more details on Sharesight. So without further ado, let's get right into the video. So to begin, I wanted to start off with an article from News Talk ZB. It basically said that the finance minister in New Zealand, which is Grant Robertson, is confident people will see Air New Zealand as a good investment. If you're new to investing, when you see headlines like this, it might give you confidence to invest in Air New Zealand shares. However, I'd encourage you not to be easily persuaded by headlines such as this. As you know, the finance minister acts for the Crown, and the Crown owns 51% of Air New Zealand shares. So there's obviously a good incentive for why the finance minister might want to say this. So don't be easily swayed by the headlines. Always do your own research before investing, and hopefully this video will help you make better informed decisions. So to begin, let's take a look at the announcement over here on the 30th of March 2022. So over here, Air New Zealand is launching a comprehensive $2.2 billion recapitalization package to help position the airline for recovery. Full details of the recapitalization are set out in the attachment. So I can't link out the attachment because it's not meant to be distributed outside to the US. So make sure you check the attachment on the website to make sure what I'm saying is correct, and don't just rely on this video. That's what I wanted to say about this. Now, the current share price of Air New Zealand is $1.26, and over the past 5 days, it has tanked 9.64%. This drop over here was on the back of the announcement. Usually, the market will react negatively when a company announces that they need to raise capital, because what this means is that money is coming out of investors' pockets, and investors usually don't like this because, first of all, not all investors have money. So to avoid getting diluted, what they do is they just sell their shares, and that's why we see this drop over here. Currently, they have a market cap of about $1.4 billion. So this is still a relatively large company compared to other companies on the NZX. So what's the deal? Over here, they're raising $2.2 billion. Of the $2.2 billion, $600 million is in redeemable shares issued to the Crown. So these shares are shares that are kind of seen as preference shares because dividends will be paid to redeemable shares first before they get paid to ordinary shares. And these shares can be redeemable by Air New Zealand. They can basically pay back the Crown for these shares and cancel them immediately. Another $400 million will be from the Crown loan, which is a debt facility, not equity facility. And then $1.2 billion will be raised from the renounceable rights offer, which is what we'll be discussing in today's video. So as part of the renounceable rights offer, you get a 2-for-1 deal. In other words, for every 1 share that you currently hold, you can buy another 2 new shares. each new share will cost 53 cents per share, and you need to have held Air New Zealand stock by Friday, 1st of April 2022 to be entitled to the rights. So in other words, if you buy the shares on market open on Monday, for example, I'm recording this on Sunday, by the way, 3rd of April. So if you buy it on the 4th of April, the shares will be trading X rights price. And so what this means is that if you buy shares tomorrow on market, you will not get the rights allocated to that share. Basically, the seller will get the rights because they held it on Friday, 1st of April 2022. So that's quite important to note. Now, you might ask, is the new shares at 53 cents per share a no-brainer? Because if the current share price is above 53 cents, then isn't this rights issue just free money for me? Because you can exercise and then you can sell the shares at above 53 cents per share. Well, the answer is not necessarily so, and here's why. For example, I have Bob over here. Bob takes up his rights fully. So Bob has 100 existing Air New Zealand shares before the record date, and of that 100 shares, he paid $1.37 per share, for example, at the pre-announcement price. So this was the share price before Air New Zealand came out with this announcement. And for every 100 shares, he can buy 200 new shares. So in this case, he pays $106 to buy 200 new shares at 53 cents per share. And now he's left with 300 shares in total. His 100 plus the 200 new shares. And the first share was $1.37, which is the price over here. And he got 2 new shares at 53 cents per share. You multiply that by 100 for 300 shares. And in total, he would have paid about $243 for a total of 300 shares, or 81 cents at the theoretical X rights price. So this is basically the price we expect the shares to trade at after the rights have been issued to the existing shareholders. So this will be Monday. We should expect the share price to fall quite dramatically from where it is currently at about $1.25. Now, this theoretical X rights price is calculated when the share price was at $1.37. Now that the share price is at $1.25, we should expect the theoretical X price to be around 76 cents or 77 cents per share. So now let's calculate how much money that Bob has actually made by exercising his rights. Now, let's calculate the difference first in the price of new shares issued and the theoretical X rights price. So the new shares that were issued were 53 cents per share, and we take that away from the current theoretical price of 81 cents per share. You multiply that by 2 shares, and you get a profit of 56 cents. All right, so that's the difference in the price of new shares and the TERP. Now, if we take the price of the existing share of $1.37 and the TERP, what you get is 81 cents less the $1.37 per share, and you are set back, or you have a loss of 56 cents. So in other words, this is not free money. Bob is paying for that, what he's getting, right? Whatever he pays, he loses in value from his existing shares. And so the money that he made from the new shares is basically offset against what he lost on his existing share. Now let's talk about another scenario over here if Bob doesn't take up his rights. What happens then? So Bob can sell his 200 rights or part of it. He doesn't have to sell all of it. He can exercise some of it and sell some of it on the NZX. So this will be tradable on Monday tomorrow. If Bob doesn't do anything with his rights will lapse and he won't be able to subscribe for any new shares. His unexercised rights will be sold in the shortfall book build. So if Air New Zealand doesn't have enough people taking up their rights offer, then Air New Zealand won't be able to raise $1.2 billion. So if this scenario plays out, what will happen is that other shareholders that are interested in buying more shares than what they are currently entitled to can participate in the shortfall book build by bidding for those unallocated rights, or the unexercised rights, I should say. And these rights will then get sold in the book build, and they will pay Bob for his unexercised rights. Now, the value of how much he will get from this shortfall book build is uncertain. Right? So we don't know how much the rights will sell for. It really does depend on what the share price is at the closing of the offer. But if he doesn't take up his rights, his ownership will be diluted by 66.67%. So in other words, for every one share that he had, there'll be 2 more new shares. So if he owned 1% of the company, now he only owns 0.33% of the company. So again, this is not free money. He is getting rights that he can sell, but he is essentially getting paid to reduce his percent shareholding ownership in the company. This is the 2 different scenarios. It is not free money. There are definitely consequences on each side. So to summarize, the essence of a rights issue is this: participating shareholders have to pay up to avoid dilution, and non-participating shareholders will have their stake diluted. This is not free money for both outcomes, and shareholders usually do not like rights issues because what this means is that they have to pay out of pocket to maintain their shareholding percentage. And sometimes investors don't want to allocate more capital into a particular stock because this could cause their portfolio to be unbalanced, to have too much allocation into Air New Zealand, and they might not be comfortable with that. So that's something that you have to consider as well. Investors like getting paid for their shares. They like dividends, they like share buybacks. They definitely do not like giving money to the company because that is the opposite of an investment. When you have an investment that requires money to be put in, that's more like a liability in that case. So then how do you decide whether or not to invest in this rights issue? Well, you have to ask yourself the real questions here. There's 2 questions that I think is very important. The first one is, will the rights issue help the company deliver higher future profits than they are currently delivering at the moment? And secondly, is this a business that you want to invest more capital into? If you can come up with an answer for these 2 questions, then you can answer whether to invest in this rights issue or not very easily. Let's take a look at whether this company will deliver higher profits first to answer the first question. Now, taken from page 8 of the investor presentation in management's forecast, they came up with a few different numbers that they expect to achieve by 2025. So the first one is by 2025, they expect capacity to reach 90% of FY19 levels, which is the pre-COVID level. Now, 90% by FY25, that is still 3 years away. So it is very possible that they achieve 90% of capacity. So that makes sense in my mind. By 2025, EBITDA to target FY19 levels. So if they can reach 90% of FY19 levels, then they should also be expected to achieve EBITDA of around that range, which in FY19 was 1.18 billion. And in 2025, net profit after tax was $276 million as well. So they expect to achieve that by 2025. And lastly, they also expect dividends to be considered from FY26. So if you're a dividend investor, do not expect to be paid a dividend anytime soon. Management has also put a disclaimer on these financial forecasts because they say that there's so much uncertainty going forward that this is only an indicator of one possible outcome. There's many different possible outcomes with, oil prices, with what's happening on the macro perspective with higher interest rates, so on and so forth, that management do not want to give you a indicator that this is highly achievable. In other words, this could be subject to change, and management are basically saying that if we get this wrong, then we told you so. So just watch out. There's a huge disclaimer on this. You can check that out on page 8 of the investor presentation. So that's something to note. We can't really place too much faith in management's forecasts over here because there's so many things that they can't control, and this can change anytime. So hypothetically, let's assume that management is correct in the FY25 forecast that net profit after tax will be 276 million by 2025. Then we can come up with a valuation today. So basically, the current market cap today is worth $1.4 billion. And you add on $1.2 billion in new equity raise, giving us a total $2.6 billion of equity value post-capital raise. And if we take the 2025 net profit of $276 million divided by the $2.6 billion in equity raise, that gives us a 2025 PE ratio of roughly 10 times. So to give you some perspective, Air New Zealand was trading at an average PE of roughly 10 times 1 or 2 years before COVID happened. So in my opinion, this is roughly where the company is worth, that you would only pay about 10 times for this type of business. Now, remember though, you're not paying for 10 times earnings today. You are paying 10 times earnings in 2025. So in my opinion, this does look a little bit rich. Management has said as well, we might not actually achieve this target. So there's a lot of uncertainty involved. Now, there's also some other risks involved as well in page 40 to 46 of the investor presentation. You should definitely check that out, read through it very carefully. There's a lot of different risks that management have highlighted, such as passenger demand is uncertain, macroeconomic conditions such as inflation, interest rates, geopolitics, fuel price volatility, increased competition, and more. So make sure you check that out before deciding whether or not to go ahead with the rights issue. So that is all that I have to say for today's video. So personally, I do not have any shares in Air New Zealand. I don't intend to buy any shares or participate in the rights issue by buying the rights on market. Personally, there's too much uncertainty involved for me to be invested. This business operates in an industry that has a lot of headwinds, in my opinion, going forward, and I don't think a 10 times forward PE in 2025 is justified. Today, there's much better opportunities elsewhere, in my opinion. So this is not financial advice. Obviously, make sure you do your own research, and hopefully this video has helped you better understand the rights issue. If you enjoyed it, be sure to share this video with someone who you think can find this information helpful. I really appreciate all of you guys watching and tuning in. Thank you guys for watching. Until next time, take care.